Hello, my name is Cameron Opfer, and today I will be presenting on Tyson Foods and the potential tools that will help the company plan for tax implications in the future. So, Tyson Foods supplies poultry, beef, pork, and prepared foods to families across the globe. They operate across multiple segments, including the poultry, beef, pork, and prepared foods, offering a wide variety of products that cater to diverse customers and dietary needs. The company's operations span from raising livestock through a network of contract farmers to processing and packaging food products for distribution to retail outlets, food service providers, and international markets. So now that we understand a little bit of the background about Tyson Foods, let's jump into possible ethical implications regarding accounting and tax laws that affect the company. A few concepts I researched that were most relevant and could benefit Tyson Foods the most were gross income and realization, the tax benefit rule, leasehold improvements, cash and accrual accounting techniques, charitable contributions, net operating loss carryback and carry forward provisions, loss disallowance provisions, non-recognition provisions, capital gain and losses, and itemized deductions. So I want to discuss a few key points that came from this research. So regarding gross income and realization, so we know that the term income is used in the code and is defined broadly, but income for tax purposes is an increase in wealth that has been realized according to our textbooks. Gross income refers to the total revenue of a company earns from its primary business activities before deducting any expenses, and that comes from what is gross income in 2022. For Tyson Foods, this encompasses the sales revenue generated from selling poultry, beef, pork, and prepared foods to customers, retailers, and other businesses. Gross income is a fundamental indicator that a company's ability to generate revenue, and it's essential for assessing its financial health. Let's move on to the tax benefit rule, and that is a provision that limits the recognition of income from the recovery of an expense or a loss properly deducted in a prior tax year for the amount of the deduction that has generated a tax saving, according to our textbook. The rule prevents taxpayers from receiving a benefit of a deduction in one year, but upon an unexpected change in circumstances in later years, receiving a recovery of items that were deducted as a loss in the prior year, according to Tax 2023. Tyson Foods can benefit from this rule when they take a deduction for a bad debt in a year. Leasehold improvements can create tax benefits for corporations as well. Leasehold improvements refer to any change made to customize a rental property to satisfy the particular needs of a specific tenant, according to CHIN 2023. For Tyson Foods, leasehold improvements are typically changes to meet a tenant's business needs. These needs could be adding shelving to a warehouse or installing security cameras. Owners cannot deduct these outlays from their taxes directly because they are considered capital improvements, but the IRS allows them to depreciate over time. Cash and accrual accounting techniques. So we all know the difference between cash and accrual accounting, and Tyson Foods utilizes accrual. But the biggest thing I took away from researching this topic was that accrual basis corporations may not deduct an expense until both the all events test and economic performance tests are met. The all events tests are met when all events have occurred to establish the existence of a legal liability and the amount of the liability can be determined. The economic performance test is met when the party obligated to do something to satisfy the liability does so. And one of the last key topics that I wanted to talk about was charitable contributions. So one interesting, ethically sound deduction that the IRS allows corporations to deduct, similar to individuals, is charitable contributions. Their charitable contributions are not required. However, the U.S. promotes these by allowing contributions to deduct certain contributions. So a charitable contribution are contributions made to qualified nonprofits. So Tyson Foods can benefit from this and can accrue contributions at year end if a payment is properly made within 3.5 months after the end of the year, according to Cornell Law School. So now let's discuss a plan of action. As Tyson Foods looks into the future, creating a logical and financially ethical accounting plan for action is obviously going to be beneficial. And in order to ensure repeated growth, transparency, compliance, Tyson Foods will need to follow a plan that involves honesty. A strong plan could include enhanced transparency in recording, cost management, innovation, risk assessment or risk management, employee development, and performance evaluations. Actions to ensure these steps will include strengthened internal controls to ensure reliable financial reporting. They will need to conduct and implement a review of cost structures to identify areas of efficiency improvements. The corporation will need to invest in research and development to innovate their food products and technology. And Tyson Foods already knows that nothing runs smoothly without proper employee development and training. However, continuing to foster a culture of integrity, diversity, and inclusion will prove to be valuable to the company. So overall, operating ethically in the food industry is essential to ensuring customer trust and well-being. According to Tyson Foods' website, their value statement says that they are a company engaged in the production of food, seeking to pursue truth and integrity, and committed to creating value to our shareholders, customers, team members, and communities. Tyson Foods is an ethically sound company already. However, continuing to invest in tax research will allow the company to thrive even more. Thank you.